Obviously, it was really the big tech stocks flattering the indexes a little bit for most of the day, lost some steam in terms of the broader market as we went on. I think the market continues to offer this very mixed picture. The trend is fine. The uptrend is intact. The major averages are within 1% or so of their all-time highs. All that sounds good. So the path of least resistance seems higher. But if you look within it, you have housing very weak, auto stocks very weak, semiconductors well off their highs, no longer leading the way. Even airlines are far off their highs. So it seems like you have these pockets of the market that are signaling concern, and financials exactly are kind of a dead weight. So all of it together says overall the market is in decent shape, reflecting a decent economy, but it seems very sensitive to the possibility of peak type activity into next year.
And Stephanie, there was some continuation from the negativity of yesterday's Fed-inspired sell-off because banks were lower, utilities were higher, so there was some interest rate sensitivity there that kind of continued to weigh, but the rest of the market managed to shrug off.
Yeah, I mean, I think the theme for this week in general has been all about rates and their gradual increase in yields. And then also it's about energy and the rise in the commodities. So those are the two things that are top of mind, at least for me and my portfolio. And I think the thing is, if you step back and see why rates are going higher, it's because the economic data is getting it's still pretty good. I mean, today you had durable goods new orders up 13% year over year. That's a huge number. You have initial claims that are down 23% year over year. So on top of that, you have consumer confidence that we haven't seen since September of 2000. So the data is good. The Fed should be raising, normalizing policy. I think what's happening is people are trying to figure out what multiple do you put on the market with rates rising, what happens to earnings? And I go back and I say, look at the economic data, and that's going to support earnings. And at 17 times, it's still very attractive.
Apple and Amazon both closing higher today after a couple of bullish analyst calls. JP Morgan initiating coverage of Apple with an overweight rating, saying they see, quote, considerable upside to the stock, in part based on its services business. And Stifel analysts establishing themselves as the biggest Amazon bulls out there with a new price target, implying a gain of more than 27% for the stock from current levels. Mike, we discussed this a little bit earlier. Stephanie, do you agree with what Mike said earlier, that there's nothing really new here? These two analysts haven't discovered something that none of us have come across before. No,
there's really nothing new, but I do agree with the analysts, and I do own both stocks. And Apple's actually my biggest tech stock. Amazon is my biggest discretionary stock. I don't worry so much about Apple as I do with Amazon, because I do feel like you have the buyback support. You do have 17 times forward estimates. You do have a free cash flow yield of 5%. And you have a story where ASPs are actually on the rise. And as we've talked about a couple of weeks ago, their cost of goods sold, 30% of them is related to NAND and DRAM prices, which are falling. So you're going to see this operating leverage. But in terms of the overall story, yeah, ASP growth and services, and that's good enough at this valuation anyway.
Yeah, I mean, Amazon, it's definitely much more sentiment driven. It's just basically the stock moves based on everybody's momentary idea of just exactly how much more dominant the company's going to become. So I don't think you have people doing these sort of channel checks. It's really not that kind of a name.
Right.
What about the fact that they're opening bricks and mortar stores are the best reviewed
and they get the benefit of the doubt for that, right? Nobody looks at that and says, wow, that's really a little bit too far afield for Amazon. No, it's like, nope, they must have it figured out.
But I think it's also, with any high multiples growth stock or secular growth stock, it's all about the TAM, the total addressable market. And they keep on finding new end markets to focus on. You may agree with them or you may not agree with them, but the growth potential is there. And then add on the fact that they're now focused on profitability on top of that, which means operating leverage, which means better earnings trajectory from here. That's pretty powerful.
What do you make, though, Stephanie, as an owner of the stock of the 4-star store in Manhattan? It's an expensive area to have a store, and it's not as obvious a sort of strategy as Whole Foods is to have fresh groceries or the checkout-less stores with Amazon Go.
And I think you have, when you have buy online, pick up in the store from all of the retailers, like Kohl's, for example, that's a big strategy for them. Someone can actually order something and then get it delivered that day. And so Amazon, while we will get it's something within a day or two, or maybe in a few hours, I think that's what they're trying to compete against, and at least have that offering as well on a delivery basis. I mean, they already have very fast speed as it is, but I think that this also kind of helps in that regard.
As a stock, I think what's really going to matter much more is if there's a rethinking of cloud services demand. There is a school of thought that says there's this massive investment cycle in cloud. Maybe it's going to calm down a little bit next year. That would probably hurt Amazon much more than any physical retail store.
Although Salesforce reached a record high today.
Yeah,
a lot of those stocks.
Still going.
And they'll make it up on the advertising side, which I think is completely underappreciated. So even if AWS comes down, you got advertising growth going higher. So you have a lot of stories here. You have a lot of stuff to talk about.